What if I told you that a company could grow its revenue by 251%, shatter every single Wall Street estimate on the board, and still watch its stock price crater 8% in a single hour after the bell? That's not a hypothetical. That happened. And today on Smart Stock Sam, we are going to tear it apart piece by piece, number by number, and level by level, because buried inside this earnings paradox is one of the most important investment theses in the entire artificial intelligence infrastructure story. Welcome back to Smart Stock Sam. I'm Sam, and this channel exists for one reason: to cut through the noise, decode the numbers, and give you the clearest, most actionable picture of what is actually moving the markets. Today, we are doing a full deep dive on two giants of the data storage world: SanDisk, ticker SNDK, and Western Digital, ticker WDC. We are decoding their fiscal third quarter 2026 earnings, breaking down where the revised price targets now stand, and figuring out exactly what you, whether you are a trader or a long-term investor, are supposed to do with all of this. So let's start with the big, beautiful, ugly disconnect. On paper, these are the greatest earnings reports in the history of the storage industry. I do not say that lightly. SanDisk posted a 251% year-over-year revenue surge. Western Digital's net income skyrocketed by roughly 600%. And yet, the moment those numbers dropped after hours, the market responded by sending both stocks straight down. SanDisk fell nearly 6 to 8%. Western Digital slipped about 8% too. So the question that should be burning in your brain right now is simple. Are we looking at peak margins, meaning this is the absolute top of the cycle and it only gets worse from here? Or are we watching the birth of an artificial intelligence-driven recurring revenue model that is about to permanently re-rate both of these companies to a completely different valuation universe? That is the exact question we are going to answer. Let's go to the raw numbers, because this is where the story truly gets staggering. SanDisk reported revenue of $5.95 billion. Wall Street was modeling $4.70 billion. They did not just beat the estimate, they absolutely annihilated it. Their adjusted earnings per share came in at $23.41, against a consensus sitting at $14.54. That is not a beat. That is an obliteration. But the real mic drop of the entire report? Gross margins. SanDisk printed 78.4% non-GAAP gross margin. In the world of physical hardware and memory chips, those are software company margins. They swung from a nearly $1.93 billion loss just 1 year ago to a $3.62 billion profit this quarter alone. That is one of the most dramatic financial reversals you will ever see in the semiconductor space. Now look at Western Digital. The numbers are smaller in scale, but the growth trajectory is just as aggressive and arguably more sustainable given where it started. Revenue of $3.34 billion beat the $3.25 billion estimate. Earnings per share of $2.72 cleared the $2.39 hurdle with room to spare. Gross margins hit 50.5% on a non-GAAP basis, expanding 440 basis points in a single quarter. Their net income came in at $3.12 billion, up from $520 million the prior year. Both companies are converting bytes into billions faster than Wall Street modeled, and yet the charts looked absolutely ugly the moment trading opened after hours. So what actually happened with the stock price? Here's the mechanical reality of the sell the news trap. Before earnings, SanDisk had already printed an all-time intraday high of $1,115. The trade was not just crowded, it was a standing room-only event. When the stellar numbers finally hit, there were simply no more buyers left to push the stock higher. Profit-taking overwhelmed demand, dragging SNDK down to approximately $1,030 in after-hours trading. Western Digital followed the same script, sliding to around $401. And here is the critical insight that separates smart money from noise. This was not a rejection of these companies' performance. This was a mechanical clearing of a crowded trade. The fundamentals did not break. The positioning did. Those are two very different things. Now let's build the bull case, because the surface level numbers only tell half the story. 3 words explain what is really happening here: artificial intelligence, data centers. SanDisk's data center revenue did not just grow, it exploded, surging 233% sequentially to $1.47 billion in a single quarter. Western Digital saw similar acceleration, with cloud revenue now comprising 89% of their total revenue pie. Nearly 9 out of every $10 Western Digital earns is now coming from the cloud. That is a fundamentally different business than the one most investors have in their mental model. But here is the number I want you to hold on to for the rest of this video: $42 billion. SanDisk has secured $42 billion in long-term supply agreements. This is the strategic shift that changes everything about how you value this company. The memory industry has historically been defined by vicious boom and bust cycles, massive profits followed by catastrophic oversupply crashes. SanDisk is now attempting to structurally eliminate that volatility by locking in multi-year contracts that transform NAND storage into a predictable, recurring revenue stream. They are not just selling memory chips anymore. They are selling guaranteed capacity to the hyperscalers, building the artificial intelligence backbone of the global economy. And if the forward-looking contracts were not enough, both companies are returning serious capital to shareholders. Western Digital raised its dividend 20%. SanDisk authorized a $6 billion share repurchase program. When a company authorizes a buyback at these price levels, they are making a very loud, very public declaration: we believe our own stock is undervalued. That is not a small signal. Now, and I mean this sincerely, because intellectual honesty is the entire foundation of this channel, I would be doing you a massive disservice if I didn't give you the bear case with the exact same level of intensity and rigor. So let's be completely honest about what is genuinely worrying analysts and keeping institutional desks up at night. The number one fear is peak margin anxiety. When analysts see SanDisk printing approximately 80% gross margins, the instinct is to ask, where does it go from here? If you believe these margins represent the absolute ceiling of the cycle, then the only direction is down, and a margin reversion from 80% back toward historical norms would compress earnings per share dramatically, even if revenues hold flat. That's a real risk, not a theoretical one. The second concern is what I call the guidance wow factor problem. While forward guidance was objectively strong, it was not the kind of guidance that sustains a stock that has already surged over 3,000% in a single year. At some valuation level, even strong becomes insufficient. And third, you have the consumer slowdown signal. SanDisk's consumer revenue actually fell 10% sequentially. The average person on the street is not rushing to buy SSDs. The artificial intelligence boom is real, but it is highly concentrated inside the hyperscaler ecosystem. That uneven recovery in the broader storage market is worth watching closely. Now let's zoom out and look at how these two companies stack up against their peers, because context here is everything. SanDisk has delivered approximately 362% year-to-date returns. Western Digital comes in at roughly 152%. Seagate is at approximately 145%, Micron at around 81%. SNDK is the undisputed high flyer of the storage sector. But here is the part that should make you stop and reconsider the narrative. Despite that massive run, SanDisk is trading at just 23.2 times forward earnings. Western Digital is over 45 times. Seagate is over 47 times. The stock that went up the most is actually the cheapest on a forward earnings basis, because its earnings grew even faster than its share price. That is the definition of a value anomaly hiding inside a momentum story. So where does the money go from here? The Q4 guidance tells you the growth story is not over. SanDisk is guiding for revenue between $7.75 billion and $8.25 billion, easily clearing the $6.49 billion consensus. Adjusted earnings per share are guided to the $30 to $33 range. Gross margins are expected to climb to 79 to 81%. If they hit the top of that range, this will be one of the highest margin hardware companies on the planet. Western Digital is guiding for revenue around $3.65 billion, earnings per share of $3.25, and gross margins expanding toward 51 to 52%. The momentum is not breaking. It is consolidating at a higher base. And there are three specific catalysts that could force the next leg higher faster than anyone currently expects, and honestly faster than the bears are even modeling. First, the QLC Stargate SSD launching in Q4. This is an ultra-high density storage solution designed specifically for artificial intelligence workloads, and it represents an entirely new revenue line that does not cannibalize existing products. It expands the total addressable market. Second, hyperscaler capital expenditures. Microsoft, Google, and Meta have collectively committed over $700 billion to artificial intelligence data centers this year alone. That is a guaranteed demand floor that does not evaporate in one quarter, and it creates a structural tailwind that competitors without long-term supply agreements simply cannot access at the same scale. And third, specifically for the traders in the room, keep your eyes glued to the short interest data. SanDisk's short interest recently jumped 21%. If any positive catalyst materializes, whether that's a strong Q4 print, a major new contract announcement, or a hyperscaler capex expansion, those shorts will be forced to cover in a hurry, and that mechanical covering can trigger a violent, fast, and frankly exciting move back toward all-time highs. Is that guaranteed? Absolutely not. But the setup exists in a way it rarely does. Let's get tactical. For SanDisk, the chart is all about the $1,000 level. This is the major put wall and the key psychological support zone. Stay above 1,000 and the bulls maintain control. But watch the $996 gamma flip level extremely carefully, because if price breaks below that level, market makers will be forced to rapidly hedge their exposure, and that hedging activity could accelerate the move downward toward intermediate support at $868.50. To the upside, resistance sits at the recent all-time high zone between $1,103 and $1,115. Clear that zone with volume, and the next major analyst price target comes into view at $1,200. For Western Digital, current price is hovering around $401. Immediate support sits between $380 and $390, aligned with the options max pain zone and recent pre-market lows. First resistance is $434 to $442. Break through that convincingly, and the big bank targets from Bank of America and TD Cowen at $495 to $500 come into play. The short-term trading strategy is range-bound swing trading. Buy near established support, $1,000 for SNDK, $380 for WDC, and trim near resistance highs. RSI on both stocks is sitting in the low 60s, in buy territory but not yet oversold. However, Western Digital's stochastic indicator is at 80.6, which means chasing a gap up right now demands caution. Wait for the dip, watch the options flow, and never take your eyes off 996. But zoom out 2 to 3 years, and the story is far bigger than any technical level. The structural bull case is this: the memory industry has always been a jagged, unpredictable boom and bust cycle. But artificial intelligence is changing the fundamental architecture of the business. Those $42 billion in remaining performance obligations are the evidence that SanDisk is transitioning from a cyclical commodity player into something that looks far more like a recurring revenue infrastructure company. Analyst consensus has a strong buy on SNDK with price targets extending as high as $1,800. Western Digital is being re-rated as a high-growth artificial intelligence infrastructure play with targets reaching $495 to $500. These companies are no longer just selling memory. They are becoming the landlords of the artificial intelligence data world. Before I close this out, I have an obligation to say the following. Nothing in this video is financial advice. I am not your financial advisor, and this content is purely for educational and informational purposes. All investing involves risk. Past performance does not guarantee future results. Always do your own research, consult a licensed financial professional before making any investment decisions, and never invest money you cannot afford to lose. The numbers, price levels, and projections discussed in this video are based on publicly available information and analyst reports at the time of recording and may change rapidly. Now, the bottom line. The post-earnings sell-off we witnessed was a structural repricing of expectations, not a failure of fundamentals. For traders, respect the technicals, play the ranges, watch 996 like a hawk, and monitor the options flow for gamma signals. For investors, focus on the shift from cyclical to recurring revenue, and consider using these sell-the-news dips as accumulation opportunities, as long as hyperscaler capital expenditures remain intact and the remaining performance obligations metrics continue to grow. Here is the question I want you to think carefully about and drop in the comments section below. Do you believe SanDisk can sustain gross margins above 75% for the next 4 consecutive quarters? And if it actually does, what does that mean for the realistic valuation ceiling of this stock over the next 18 months? I want to read your actual analysis, not just a price prediction. Let's build the sharpest, most informed financial community on YouTube together, because the best insight in any comment section I have ever read did not come from me. It came from you. If this breakdown gave you clarity, smash the like button. It genuinely helps this channel reach more people who are trying to invest smarter. If you are new here and you want earnings breakdowns, price target analysis, and market deep dives like this every single week, hit subscribe and ring that notification bell so you never miss a drop. And if Smart Stock Sam has ever helped you make a better informed decision in the markets, consider sending a super thanks using YouTube's support feature. Every single one goes directly back into making this content better, deeper, and more valuable for you. This is Smart Stock Sam. Stay sharp, stay patient, and I'll see you in the next one.